How do you think about this bubble talk that has been going on for the last few months especially? I mean, I think it's quite possible. Ladies and gentlemen, on the 25th of June 2026, Apple did something it has never done in its history. In the middle of the year, with no new product launch, it simply raised prices. The MacBook Air went up by 18%, the iPad Pro went up by 20%, the Apple TV went up by 54%. And when people asked why, Apple said something remarkable. They said they had never seen component prices rise this much, this quickly. The reason your laptop got more expensive has almost nothing to do with Apple itself. It has to do with a war being fought over tiny memory chips, thousands of kilometers away, in factories most people will never think about. Now, look at this graph. In 2020, before ChatGPT even existed, the four biggest US tech companies combined spent $90 billion on capital expenditure. By 2023, that number was $147 billion. By 2025, it had jumped to $410 billion. And in 2026, it is sitting at $725 billion. In 6 years, capital spending on this single bet has grown eightfold, and all of it is coming from just four companies: Amazon, Meta, Google, and Microsoft. At the same time, the stock market was so intoxicated by the AI wave that on the 2nd of June 2026, Nvidia was worth $5 trillion. Analysts everywhere were telling people to buy AI stocks without hesitation. But just 3 days later, something started cracking. Nvidia lost $320 billion in market value in a matter of days. By the 24th of June, Micron was down 13%. SanDisk had fallen more than 10%. Apple dropped 6.1%. SoftBank tanked 12%. On top of that, OpenAI quietly delayed its IPO. And slowly, warnings began coming from some of the most respected voices in finance, comparing the mood to the years just before 2010. So what's the real answer here? Is this a bubble that eventually bursts? I think it is, yes. The trouble with the AI capital spending boom isn't just its size, it's that a large chunk of it is being funded with debt, and debt-fueled pain doesn't stay contained. It spills into the rest of the economy. The second thing that happens when people get this excited about a technology is that every experiment gets funded, whether it deserves to be or not. This isn't just a financial bubble, it's an industrial one. I went back and studied every major bubble in modern history to understand this properly. I read the Wall Street Journal, the Financial Times, CNBC transcripts, and even JP Morgan's internal analysis to understand why serious investors like Ray Dalio are calling this a textbook bubble. By the end of this, you'll understand this topic better than almost anyone around you. Whether this turns out to be the greatest business bet in human history or the greatest bubble ever inflated. Why are people like Michael Burry, Ray Dalio, and Jeff Bezos all hinting that this is a bubble? And what actually happens if it bursts? Let's get into it properly. Before we go further, I need to install one mental model in your head, because without it, none of the numbers ahead will make sense. Picture your phone. When you type a question into ChatGPT, your phone doesn't do the thinking. Your phone is just a screen with a Wi-Fi connection. The actual computation happens somewhere else entirely, inside a giant, windowless industrial warehouse packed with metal racks. Each rack holds thousands of specialized chips. That warehouse is what we call a data center. A single one of these buildings can hold up to 100,000 NVIDIA GPUs. Each GPU costs somewhere between $30,000 and $40,000. That means one building alone can hold $3 to $4 billion worth of chips. And that's before you've spent a cent on anything else. On top of that, you need to power these chips, cool them, wire them together with high-speed cabling, and house all of it inside concrete structures with serious fire suppression and security systems. All told, a single large AI data center costs somewhere between $10 and $25 billion to build. This is the race that's actually happening right now. Here's why it's happening at this scale. In 2010, the entire world created or copied about 2 zettabytes of data, roughly 2 trillion gigabytes. By 2026, the world is projected to generate 221 zettabytes of data in a single year. That's more than 100 times what we produced in 2010. Put simply, the world now produces more data in a single month than it did in all of human history up to the year 2010. That explosion is the real reason data center investment jumped from $90 billion to $725 billion in just 6 years. Now here's a number that should genuinely worry you. According to a PIMCO report, Big Tech's capital spending is set to consume 94% of their operating cash flows over the next 2 years. 94%. That means if these companies earn $100, 94 of those dollars go straight back into building AI infrastructure. Only $6 are left over for dividends, buybacks, salary increases, other kinds of innovation, and everything else a company needs to fund. In 2023, that same ratio was only 40%. It has more than doubled in just a few years. So think about what that actually means. Big Tech is betting 94 cents of every dollar they make on a single assumption. that within 5 years, the world's demand for AI computing will be so enormous that everything being spent today will look like a bargain in hindsight. That sounds unstoppable on the surface. But here's where it gets dangerous. Let's step away from the tech world for a second and think like a small business owner. Imagine you spend $10 million building a coffee machine factory. After all that investment, your factory only manages to sell $400,000 worth of coffee machines in an entire year. Is that good, bad, or terrible? It's terrible. Nobody in their right mind would build a second factory if the first one isn't making money. Now apply that exact same logic to AI. JP Morgan actually ran this calculation, and the math is straightforward. If you're an investor putting money into a risky venture, you expect at least a 10% return. That's the bare minimum any serious investor demands. So JP Morgan asked, how much revenue does AI actually need to generate every year to justify all this spending? The answer was $650 billion a year. Hold on to that number. Now let's look at what AI is actually earning today. OpenAI, the makers of ChatGPT, brings in about $25 billion a year and loses roughly $14 billion a year doing it. Anthropic is on track to hit somewhere around $26 to $47 billion depending on how its current run rate plays out. And it's still operating at a loss too. Add in Google's Gemini at roughly $25 billion, and every major AI model company combined brings in around $75 billion a year, while several of them are burning billions in losses at the same time. So put these three numbers side by side. What AI needs to earn to justify the spending, $650 billion. What AI is actually earning, $75 billion. What the giants are collectively spending on infrastructure, $725 billion. The gap between what's being earned and what's needed to break even is roughly 9 to 10 times. For every single dollar the AI industry brings in, the tech giants are spending $9 to $10 more than that. This is why one Wall Street analyst has called it the $600 billion question. A massive annual revenue gap that nobody has a clear answer for yet. Now, the biggest counter-argument to all of this is simple. Enterprises will eventually pay for it. Every one of these companies will become profitable once big businesses start relying on AI to cut costs. That argument sounds reasonable until you look at the actual data. McKinsey found that 73% of enterprise AI deployments are failing to achieve the return on investment they projected. Boston Consulting Group found that only 5% of companies are seeing substantial ROI from their AI spending. MIT found a 95% failure rate in achieving measurable financial returns from AI projects, and only 29% of executives can even properly measure their AI return on investment in the first place. This is where the story takes its first real turn. Meet Flo. He runs a small AI startup in San Francisco called Lindy, with about 25 employees. In June 2026, he gave an interview to CNBC that shook parts of the industry. His team was spending more money on Anthropic's Claude API than they were spending on their entire payroll. So what did Flo do? He switched 100% of his company's traffic over to DeepSeek, and his costs dropped by 90% almost overnight. Around the same time, Uber's CTO publicly admitted that Uber had blown through its entire annual AI budget in just 4 months. That, right there, is the twist nobody planned for. The entire business model for these AI giants assumed enterprises would keep paying more and more for AI tokens indefinitely. That assumption is why OpenAI is valued at roughly $850 billion, and why Anthropic is valued at roughly $965 billion. But by June 2026, enterprises had started doing something the market didn't expect. They started actively hunting for cheaper alternatives. This is exactly why Palantir's CEO, Alex Karp, said something striking on CNBC on the 1st of July. He described enterprises telling him they're paying for tokens that create no value and accused some AI companies of essentially charging a tax on businesses by overselling capabilities the models haven't earned. Palantir isn't a small player either. It sells to the CIA, the US government, Airbnb, JP Morgan, and dozens of other major institutions. When its CEO says something has clearly gone wrong, that's not a small signal. At this point, you might be thinking, this is a rich person's problem. NVIDIA losing $500 billion in market value, or Sam Altman, or Dario Amodi, or Sundar Pichai losing paper wealth. How does that affect an ordinary person? Let me take you to South Korea to show you exactly how. There's a Samsung factory that manufactures a specific kind of memory chip called DRAM, the same kind of memory that goes into your laptop, your smartphone, your gaming console, and even your washing machine. Back in 2024, Samsung faced a choice. It could sell its DRAM to regular consumer companies like Apple, HP, or Dell, or it could sell a specialized, far more expensive version, called high bandwidth memory, to AI data centers. Guess which one paid more? The AI data centers paid roughly 10 times more per module. So Samsung, SK Hynix, and Micron, the three companies that control about 90% of the world's memory chip supply, did exactly what any factory would do under basic capitalism. They shifted the vast majority of their production, more than 90% of it, toward AI memory, because capital always flows toward the highest bidder. Now watch what happens once you scale that decision up across the entire industry. DRAM prices rose 171% year over year as of March 2026. DDR5 memory prices are up 4 times since September 2025. Contract prices for PC memory rose 105 to 110% in a single quarter. Dell's CEO said the price of 1 gigabyte of DRAM went from 43 cents to $2.39 in just 6 months, a 5.5 times increase. That is the exact chain of events that led Apple, the richest and most vertically integrated tech company on earth, to raise prices in the middle of a product cycle for the first time in its history. When even Apple says it can no longer absorb these costs, that tells you something about how deep this actually runs. This is the invisible AI tax that ordinary consumers are already paying, whether they use AI tools or not. Here's a viewer question worth addressing directly, because it comes up constantly in the comments. If the GPUs inside these data centers become obsolete in 3 to 4 years, doesn't that make the whole infrastructure bet even riskier than the fiber optic comparison suggests? It's a fair point, and it matters. Fiber optic cable, once buried, can sit underground for decades without degrading in any meaningful way, which is exactly why the leftover infrastructure from the dot-com crash could be picked up cheaply years later and still power the modern internet. GPUs don't work that way. They physically degrade, and newer chip generations make older ones commercially obsolete within a handful of years. That means today's $10 to $25 billion data centers may need large reinvestment cycles just to stay competitive, not once, but repeatedly. If demand doesn't show up fast enough to justify replacing hardware that's barely paid for itself, that's a very different kind of bubble than we've seen before. One where the wreckage might not be worth salvaging the way it was with fiber. There's also a pricing pressure argument worth raising here. Chinese labs have released increasingly capable open-weight models. Once a genuinely competitive open-weight model exists, it becomes very difficult for any single company to aggressively raise token prices, because businesses can simply deploy their own version of an open model instead of paying a premium. That puts a ceiling on how much AI companies can charge going forward, even if they desperately need higher revenue to justify their spending. So why are Amazon, Microsoft, Google, and Meta still increasing their spending if enterprises are already cutting costs and Apple can't absorb the price increases? The answer lies in one of the most useful concepts in economics, and it explains almost every bubble in modern history. It's called the capital cycle, and it has 4 stages. First, high returns attract capital. Second, capital keeps flowing in until overcapacity gets built. Third, that overcapacity eventually causes a collapse. Fourth, most participants lose badly, except for a small number of survivors who eventually make a fortune once real demand finally catches up. Nearly every major bubble in history has followed this same pattern. In 1996, the United States passed the Telecommunications Act because, much like AI today, the internet was exploding and everyone could see it was the future. Data traffic was growing so fast that some founders genuinely believed internet traffic would double every 3 months. Money poured in to build fiber optic cable networks across the country. In the 5 years following that act, telecom companies invested more than $500 billion into cables, switches, and networking equipment. Look at the financials from that era, and the parallel to AI becomes obvious. Global Crossing went from a modest startup to a $47 billion valuation without ever posting a single profitable year. Corvus, a fiber equipment company, pulled off a $1.1 billion IPO with literally zero revenue and still carried a $32 billion market cap. Then came the collapse. Everyone had assumed internet traffic would grow by 1,000% a year. It actually grew by about 100% a year, which was genuinely impressive, but nowhere near enough to justify the scale of investment that had been poured in. By the early 2000s, as little as 2.7% of all the fiber that had been laid was actually being used to carry data. More than 95% of it sat completely idle underground. Once it became clear there was no revenue to match the investment, bandwidth prices collapsed by up to 90%, and the giants of that era started failing one after another. WorldCom, after hiding $3.8 billion in expenses to fake profitability, filed the largest bankruptcy in U.S. history at the time. Global Crossing, once worth $47 billion, went completely bankrupt. In total, the telecom crash wiped out roughly $2 trillion in market value, with stock prices falling as much as 95%. And then came the 4th stage, the survivors. This is the part of the story that makes it such a powerful mirror for what's happening with AI today. Those fiber optic cables didn't disappear once the companies that built them went under. They stayed, buried in the ground, and within a few years, real demand finally caught up. YouTube launched, streaming took off, cloud storage became mainstream, smartphones became ubiquitous. Suddenly, the world genuinely needed all that capacity that had been built years earlier, seemingly for nothing. The survivors bought up that abandoned infrastructure for pennies on the dollar, and it became the physical backbone of the modern internet. The same infrastructure that made Google, Netflix, and Amazon Web Services possible. So notice what actually happened here. The technology was completely real. The internet genuinely did change everything. But the bubble still burst because demand was growing fast, just not fast enough to justify the pace at which capacity was being built. The technology survived. Most of the companies that built it did not. This pattern isn't new either. Britain authorized 9,500 miles of railway track in 1846, and roughly a third of it was never built before that bubble burst. America laid millions of miles of fiber optic cable by 2000, and 97% of it sat unused when that bubble burst. In 2026, America alone is building $725 billion worth of data centers every year. And right now, nobody actually knows how much of that capacity will end up being used. So will this turn out to be the greatest technology story ever told? Or will it be remembered as the greatest bubble in modern financial history? Only time will really answer that question. So is this definitely a bubble? Honestly, we don't know that for certain yet, and here's why. The companies at the center of the telecom bubble were heavily funded by debt, and most of them were losing money the entire time. That's not quite true here. NVIDIA earned about $120 billion in net income last year. Microsoft, Google, and Amazon are, by many measures, among the most profitable companies in human history. These aren't fragile, debt-laden startups. They're companies with enormous cash reserves behind them. Compare valuations, too. At the peak of the dot-com bubble in 2000, the NASDAQ 100's forward price-to-earnings ratio was around 60 times earnings. Today, it sits closer to 26 times. That's higher than a normal, healthy market, but nowhere near the extremes of 1999. So if anyone tells you with total certainty that this is a bubble, they're not being honest with you. And if anyone tells you with total certainty that it's definitely not a bubble, they're not being honest either. The truth sits uncomfortably in between. There is a genuinely high probability of a bubble here, but it isn't a certainty. The technology itself is real. The revenue, however small relative to spending, is real too. Nobody serious is arguing that AI won't change the world. The real question is whether the price the market is paying for that future actually makes sense today. So what actually happens if this bubble bursts, and what happens if it doesn't? There are really two broad paths here. Path one, the bubble pops. Jobs get lost across the tech sector, the NASDAQ drops sharply, and every major tech company slams the brakes on spending. That spending is what currently feeds a large part of the IT and services sector in countries like India. If that spending disappears, the next generation of entry-level tech jobs may simply never materialize the way earlier generations expected. Path two, the bubble doesn't pop. Instead, to justify their trillion-dollar valuations, these companies race toward profitability by any means necessary. That likely means the price of using AI, the actual token cost, goes up substantially. Only the largest, wealthiest companies would be able to comfortably afford frontier-level AI at scale. The cheap, almost throwaway AI tools that consumers use casually today could become an expensive luxury. A lot of today's AI-powered products might not die because the technology failed. They might die simply because it became too costly to keep running them. There's a smaller third possibility too, one worth mentioning honestly, even though it's the least likely outcome. Some combination of falling token costs, genuine enterprise willingness to pay, and real productivity gains could align well enough that most players come out ahead. It's possible. It's just not the way to bet. One more point worth raising, honestly, because it changes the emotional shape of this story compared to earlier bubbles. The railway bubble and the fiber optic bubble both eventually created more jobs and more opportunity once demand caught up with the infrastructure that had been built. AI may not follow that same script. A meaningful part of the current AI investment thesis is built specifically around replacing human labor, not just supporting it. If that plays out as intended, the recovery phase after any AI bubble might look very different from the recovery phase after the dot-com crash. It might come with less job creation on the other side, not more. That's not a reason for panic. It's a reason to watch this particular cycle more closely than the ones that came before it, because the assumptions baked into it are genuinely different this time. This has been the story of one of the largest bets in modern business history. Whether it ends up being remembered as visionary or reckless will likely depend less on the technology itself, and more on how honestly the numbers behind it are allowed to catch up with the story being told about it. That's all for this one. If you found this useful, consider sharing it with someone who's been asking you the same question. Thanks for watching, and I'll see you in the next one.